I don't want to see my money fall. People's biggest concern is the possibility of loss. How should I think about it?
The statistics that's really scary is in the past 20 years, if you missed the top 25% best trading days, your performance would have been...
Okay, so today I am sitting here with Etienne Nel. Now, this gentleman I met a number of months ago, and he is with Old Mutual Private Wealth. And I must say, this oak knows he knows his stuff. And so, Etienne, thank you very much for talking with me today. And the reason why I wanted to speak to him today specifically is because we've touched on a lot of things such as investments, estate planning, trust, wills, the whole thing. But there's always this question about why this company, why this specific product, what is the cost implications, and so forth and so forth. So I thought, well, get a specialist in here and let's ask the specialist to give us a bit of guidance. So I hope that what I'll be discussing with him will be to your benefit today and will answer some of your questions. So Etienne, once again, thank you very much.
Thank you.
Before we start with all the technical stuff, let's first ask, who is Etienne Nel and where does he come from? What does he do?
So, Corné, I'm one of those rare individuals, I'm told, that knew exactly what he wanted to do since he was a boy. So for me, it was just being a stockbroker and buying and selling shares. So my history is I literally started trading shares in 1992 on the JSE floor.
How old were you then?
I was 21.
Goodness gracious.
And
straight out of army.
something like that. Straight out of varsity, actually. And then after that, so I was an unauthorized clerk on the JSE floor.
Okay.
Which, and back then the JSE had a system of what's called open outcry. A lot of people would have seen it where you've got lots of people standing on a trading floor, screaming and shouting across each other, and it looks like organized chaos, and which it actually is. It's very organized and very structured. South Africa's trading systems are obviously no longer there. We're all digital, and we trade on platforms. We've come a long way since then. So in essence, I've been in capital markets for 35 years of my life. I've, for the biggest part of that, serviced high net worth individuals where we managed their direct share portfolios.
Okay.
And then obviously with the relaxation of exchange control, we were able to put money offshore. And now we manage clients' money both locally and offshore, but once again, still in direct bespoke share portfolios.
Fantastic. Well, that's awesome. You know, I actually spoke to a young gentleman just yesterday, where we were also having a discussion like this, and he also said he's 22 years old. He says he just knew this is what he wanted to do. I mean, I kind of fell into the insurance industry, so it's me. it's something I learned to love.
Yes.
And to me, I just find it amazing always when I speak to somebody that says that, yeah, that's just what I wanted to do. Well, fantastic. So, sir, let's do a follow-up on that one, and let's go to the company that you are working for, Old Mutual. Why Old Mutual Wealth? Why this specific company and this specific investment product or platform?
Right. Corné, that's actually, for most people it would seem like an obvious question, but it's also a really important question. I'm a personally big believer in context. And the context is, and now that you know my history, is as South African investors, you couldn't always do what you do now. What does that mean? So 30 years ago when I started in financial markets, you needed to have a personal relationship with a stockbroker.
Correct.
Okay. And there was a very exclusive club to get into. But furthermore, you couldn't structure your entire portfolio in such a way that it becomes tax efficient. You could literally just buy shares.
Yeah.
What Old Mutual Wealth have done is built an incredible platform that enables independent financial advisors and clients access to Old Mutual's broader offering. Now, to put it in perspective, Old Mutual is probably one of the oldest companies in the country. We're officially 180 years old this year.
They are the oldest.
Yes. And a lot of people sort of dismiss that. But at the end of the day, it says something about the company where you put your money.
Yeah.
Have you been around for 10 years or 180? It speaks to an ethos which then ultimately is distilled through your portfolio. What does that look like? Well, we are able to use the greater Old Mutual balance sheet to, by example, put money offshore. We can do direct portfolios. We can do structured products. And if you would like some tax structuring on top of that, we can put it into retirement funds, endowment policies, all those kind of products Old Mutual already have on platform. So effectively what I'm saying to you is this is a hybridized approach and ultimately it benefits the client. There are a number of firms that offer something similar, but not quite in terms of the depth and breadth that Old Mutual Wealth, and specifically our division, the private client team, can offer high net worth individuals.
So if I listen to what you're saying now, basically Old Mutual, there's power in the size. That's first of all.
Yes.
And we all know that. The bigger the company, the more negotiating power they have. And there is the diversification in terms of the products, so diversified that you can basically offer more, so to speak, than the majority of other companies.
Quite literally. That is 100% right, Corne. So, it's a common known fact that Old Mutual manage in excess of 1.3 trillion rand in client money. What does that mean for you? It basically, to your point, it means that we are able to have access to markets and products, structured notes that nobody else has.
Yeah.
And that ultimately is to the benefit of our client.
It's very important. It's not always just about the company and being a place of employment, but I think very importantly, the company values that goes hand in hand with that. And you've just basically pinned that down with regards to what you said. So fantastic. So the next thing I would like to get to, sir, as we move further, closer and closer to the important questions that I think clients want to know, is how would you describe risk when it comes to a client's investments? And I think you know what I mean when I say how do you describe risk? Because as you know, clients have this thing often that I want my money to be guaranteed, but I want the best return on investment. That is almost, not almost, it is impossible. But how do you explain risk to somebody to put it in perspective for them in terms of growth and getting growth?
Yes. Corne, risk means different things to different people. And that cannot be underemphasized. So what we do at private clients is we have a conversation with the client and the advisor. And it needs to be a conversation. It's not a box ticking exercise to say you're low, medium, or high risk.
Yeah.
To my mind, that doesn't really exist because you get some people that understand risk, typically an entrepreneur who's in his own business. He understands the risk involved in doing business, but he doesn't understand the risk inherent in financial markets. So typically what we'll see is clients say to us, I want a guaranteed product.
Yeah.
Well, what does that guarantee mean? The guarantee is only as solid as the balance sheet underwriting it. And that is a direct function of what we saw in 2008. Remember when Lehman Brothers and Bear Stearns and all those big companies went bust?
Yep.
Lehman Brothers was 150 years old.
Yep.
Okay. So the point is, if I say to you, I will offer you a diversified share portfolio, you are effectively buying into a diversity of various companies. and you need to see them as businesses. So in that context, that is by definition lower risk, even though it's a share portfolio,
Correct.
which is traditionally perceived as high risk.
Yeah.
But what a lot of people tend to lose sight of is ultimately your pension fund, that is supposed to be the low risk bastion of preservation of your wealth for you to retire one day. 75% of that is invested in shares.
Yeah,
Okay.
absolutely.
So to me, risk is a discussion with the client, and ultimately we then tailor a solution built for that client to effectively address his concerns and risk appetite.
I just want to come in there with regards to that discussion, because, and I know I'm going to get a bit stuck on this for a second or two, is the perception that people have about, I want a guarantee. And a guarantee, like you said, what's a guarantee? Is a guarantee I want my capital back? Is a guarantee I want my capital back plus a certain amount of growth? But at the same time, I want the highest possible growth. And I think when advisors look at that, they tend to get stuck on a guarantee would be a fixed bond, because that is where you put the money and you're going to get X amount back. And a high risk investment or high risk portfolio would be a portfolio that consists out of 100% shares. And in between, you will find a medium risk portfolio where you've got some property, some cash, some bonds, and then a portion of shares. And I think when clients look at investments, this is what they perceive to be high risk and low risk, because that is how it's been positioned out in the market. So when you talk about a portfolio, a risk portfolio, being diversified and giving protection, but also giving good growth, that would be perceived as high risk. But actually it's not. Because at the end of the day, and this is how I try and explain it to my clients, is if I put you into a certain portfolio and the portfolio manager has bought into 100 different companies, one of them might go under tomorrow, but definitely not all 100 in one go. And if all 100 does go in one go, well, get your tent out, get your rowing boat. It's time to get the hell out of Dodge. That's the way that I try and explain risk to people. Would you agree that that's a fair understanding of risk?
Yes. Corné, I think it's really important to also, and I come back to the point I made earlier about having a conversation. So, for example, if you have a guaranteed commitment, okay, that for whatever reason in your life has arisen, you need to look after a family member, certain medical expenses are non-negotiable, then you would look at something that gives you a so-called guaranteed return.
Yeah.
Okay? Why is that? Because you absolutely cannot afford to have any volatility in the underlying asset, right? But having said that, that asset then, by definition, will not grow as fast as something that is a bit more diversified and has a bit more volatility, like a share portfolio. The minute you start introducing bespoke and well-constructed share portfolios, the impact that has is, and you're 100% right, but not quite at the 100 share level, because then you just diversified out of growth.
Yeah.
So at private clients, we look at share portfolios and typically look at anything between 18 to 23 shares in the portfolio, right? Which ultimately speaks to the point that working on 20, just round numbers, 20 shares, 5% in a share. If one of them goes bust, let's say, for example, like a Steinhoff, it's a very well-documented example, how much do you lose of your capital? Well, it's just 5% of the total.
Yeah.
The part that people struggle with is the volatility.
Yeah.
Okay? And people perceive risk in that volatility. And I think we can maybe touch on it later in the conversation, but effectively, the risk that you run by having this fixed commitment that we referred to earlier, be it looking out for kids or a parent that's living with you, medical expenses, that sort of thing, you absolutely cannot afford that volatility, then you go into a fixed product. But to the extent that you need growth, you must be in growth assets, because over the long term, the growth asset will grow. Why? Because it's a company. It's a business run by professional business people. And people need to, investors particularly, need to understand that, I always say to people, look at a company like Standard Bank. Do you think they're going to go bust tomorrow? And then this response is usually, no, not really.
Yeah.
Okay, do you think Old Mutual is going to go bust tomorrow? No, not really. And if you start building out on that conversation, and you have 20 companies who ask you, ShopRite, are they going to go bust? MTN, Vodacom, that sort of thing. Very soon you realize, but wait, these companies have been around for 20, 30, 40 years. They're not going to go bust tomorrow.
Correct.
And I think the point you were making is, to the extent that Standard Bank does go bust, we've got bigger problems to worry about in this country on a global stage due to external geopolitical factors, for whatever reason, rather than worrying about your share portfolio.
Yeah, absolutely.
Like you say, get your tent and get your boat and start paddling.
Get down those. Absolutely. Fantastic. Thank you very much. So the next thing I want to touch on here, where's my little sentence? What is your opinion on people that want to take and move all their money out of South Africa and invest it all internationally? Because that seems to be, I don't know.
All the rage.
It's all the rage all the time.
Yes.
I mean, South Africa by now should have been bankrupt with the amount of people that want to take everything out. But what's your opinion about people that just wants to move everything out of South Africa all the time?
Once again, it comes down to context. Okay? So to place it in context, South Africa in the apartheid years had sanctions imposed on us.
Yes.
In that context, we had exchange controls imposed by the South African Reserve Bank on companies and citizens. Okay? The rationale at the point was to protect the South African economy, the balance of payments, and the value of the rand. So it doesn't completely tank and destroy value for the rest of the country. Okay? So that's why we have exchange control. Fast forward to 1994, the ANC came into power, and I don't know if you remember, but everybody was super excited that we're now going to abolish exchange control because there's no more sanctions, and this is a free democracy and a free economy. Surprise, surprise. It didn't happen, and fast forward 31 years, here we are, and we still have exchange control.
Correct.
What does that mean for the man in the street? It's really important to understand that and I always use Switzerland as a nice neutral example. So if you're a Swiss citizen and you have €1 million, where would you invest it? Did you know that as a Swiss citizen, you can literally buy shares in Japan, Hong Kong, Singapore, New York, London, South Africa? It doesn't matter. You can buy shares on the Auckland Exchange in New Zealand.
Yeah.
You have that flexibility. What is the impact? Well, the impact is you as an investor on a global stage have a choice of over 30,000 global shares, right? Rationally, what do you do then? You look at growth opportunities, those sort of things. That's my job as a portfolio manager, and typically that is what you have to do. So the narrative to put money offshore isn't fundamentally flawed. It's not wrong. The reason people do it is, and we get this a lot, where people say, oh no, going offshore is a sure thing. Well, it hasn't been in the past year because the rand actually strengthened.
Correct. Yes.
So it wasn't a sure thing.
Yeah.
So the point I'm making is horses for courses. Once again, it's a conversation with the client. What is it that you need? So to the extent that you have, let's say, for example, a living annuity, which we offer, you can really, through Old Mutual Wealth's platform, put 100% of that living annuity offshore. It's completely doable. We've got asset swaps and mechanisms that facilitate that. But the reality is, in a living annuity, you have a monthly drawdown, anything between 2.5% and 17.5% annually of the value of your portfolio.
That's right, yes.
Now, if you think about the mechanics, you put everything offshore, every single time I bring money back, that means I have to sell money. Sell shares on a global exchange, the transaction costs, and then convert the dollars back into rands and put it into South African rands, and then pay it into your bank account, right? So typically what we'll do, or ideally what you should do as a South African investor, is have some of your income structured in South African rands, so your transaction costs is much lower, which ultimately comes out of your pocket, right?
Yeah, absolutely.
Never forget that.
We can try and
Sugarcoat
it as much as one. That's the way it is.
That's the way it is. And effectively, you then leave, let's say, 75% offshore for growth, and the other 25% locally to generate the income. Because in South Africa, we still have some of the government bonds that paying you 11% yields. So we can get a higher yield, which effectively addresses your income flow. And that's where the financial advisor comes in terms of having a conversation with the client and structuring the portfolio appropriately for that client's needs. But to say offshore is a sure thing, there is no such thing as a sure thing.
I'm glad you used the example of Switzerland and being able to invest across the globe. I think, and I think this is why I like it, is because the South African public is always saying, the man in the street that you talk investments to that wants to move everything offshore, they normally want to move everything offshore because South Africa is going down the drain, the economy is going down the drain, everything is just going to hell, and that's it. That's why we must move everything offshore. And I think if one looks at it from the way that you explained, with the people in Switzerland can literally invest wherever they want in the world and not invest in their own country.
Yes.
Because we are looking at the value. We're not looking at the crisis or semi-crisis that there is with our own political structure. Then you are looking at the investment from the right angle. You're looking at the investment from value point of view and not from being scared.
Emotional.
Because of, being emotional. Now, so there I want to then touch on, because I like the fact that you've also attached on the living annuity, and now the cost implication would actually be lower for a local investment on a living annuity than for the international living annuity, so to speak. So then I think the follow-on question is, if we can get people to start thinking value instead of emotion, what is your opinion in terms of the South African market? Is there still value in South African market and shares and companies?
Corné, yes, there is. Interestingly enough, the South African market outperformed the MSCI World Index last year.
Mm-hmm. Okay.
And I think we just marginally outperformed the S&P 500 as well, in rand terms. So, it is really important for a portfolio manager like myself to look at investments unemotionally.
Good.
Right? You touched on it earlier. People do get emotional because investing for them is an emotive issue. That's why you employ someone like me to be unemotional about investing money, and I look at it purely as a financial risk mitigation exercise for the client and to optimize returns given a particular mandate. But insofar as the South African context is concerned, there are always opportunities. I mean, the big story for South Africa right now is, incidentally, mining shares. So platinum and gold all running really hard. And in that context, South Africa is number one again. So,
well, that's awesome. I think this is something that people have to hear, and more than just hear, understand. It's about the value. It's not about it's better to be outside of the country or the political situation is going to crush everything. If you do look at it properly from a value perspective, and like you say, not emotionally, then you actually start seeing the value in the right places. And if a person can do that, they will always, I believe, be successful in their own financial planning and their wealth building. And this is, folks, why we make use of experts. Everybody always wants to complain about the commissions that's being paid and the fees that's being paid. This is why people are paying this. And people are willing to pay some good bucks out there. to have somebody like Etienne manage a portfolio so they can sleep peacefully every night. Okay, I'm glad we got a bit stuck there on the value thing. This leads into my next question that I have for you. What process does private client team at Old Mutual Wealth follow to select shares that go into a client share portfolio? And I think hand in hand with it goes, what role does asset allocation play in a client's investment portfolio, and how can a financial advisor help with that process? Hope I haven't overloaded with that question.
You did a bit, but that's okay.
Oh, you talk so eloquently. I might as well get it out and just sit here and relax.
Thank you. If I may, I'll start answering the second question first.
The second question first. What role does the applicant? Okay.
And that's really important, because what we do is we partner with financial advisors like yourself to have a conversation with the client. Ultimately, the advisor then decides on the asset allocation. What does that mean? Well, it means how much money are we putting into cash? How much money are we putting in South Africa, offshore? And what percentage are we putting into, as we discussed earlier, lower risk type assets because we've got financial commitments, and how much money are we putting into growth? As a portfolio manager, my role is very specific. I manage a client's share portfolio and the investments around that to a particular mandate. Okay. Once again, that is the role the advisor plays. And within the Old Mutual Wealth business, it is a key differentiator for us, where we partner with advisors to drive that process. Okay. Insofar as the stock selection process is concerned, we have a team of very clever people, PhDs, CFAs, and actuaries that go out and analyze companies. And we often get the question, there's this perception that the stock exchange is like a bit of a casino. You know, you throw a dart at a board and hopefully you win. And what's happening now is everybody says, what about AI? And the question is, yes, what about AI?
Yeah.
What part of it? Are we talking the chip manufacturer? Are we talking the data centers? Are we talking the energy that's needed to power the data center? Which component? Are we talking the potential disruption to global economic framework as a result? Because let's be honest, as a result of AI, certain people are going to lose their jobs. But in the same breath, new jobs are being created. So there's always something happening. So we follow a very rigorous stock selection process, and we've got a philosophy where we do not overpay for businesses. There's a valuation metric that we use, and I can get really technical here, but I don't want to bore the audience with some of the, discounted cash flows and PE and PE growth models and so on and so forth. But ultimately, I think what's important is, if I could distill it down to its essence, you look at a portfolio as a selection of businesses. We look at buying businesses like a business owner, right? So now here's a question. Where do you bank? Well, maybe Capitec, Standard Bank, or FNB. Well, why don't you have shares there? Just
Absolutely.
as a starting point for a share portfolio, because a lot of people say to me, well, where do I start? I don't know where to start. Where do you shop? You shop at Pick n Pay, Woolies, or ShopRite? No.
Yes.
Right? And a lot of people nowadays are saying ShopRite. So guess what? We've got ShopRite in the share, in the portfolio. Who's your cell phone provider?
Vodacom MTN.
Vodacom. And all of a sudden, you see the makings of a share portfolio. Yeah. And that's principally because we look at it from a point of view of buying a business. So it's not just the name, it's not just the number somewhere. It is an entity that's actually adding real economic value to everyday people around the world. And the same context, we do that not just in South Africa, but obviously on a global stage. So we look at the likes of, for example, there's a company called Honeywell, which I like a lot. and nobody's heard of it. But if you go into a hotel room, you'll see there's a Honeywell thermostat sitting on the wall sometimes.
That
So the biggest thermostat manufacturer in the world. If you get onto an aeroplane, a lot of airplanes have you'll see on the tail there's an exhaust. And when it's standing on the apron, usually there's sort of an emission coming out of that. Yeah. Honeywell manufacture that. That's something called the auxiliary power unit. And that powers everything within the airplane before takeoff. It's not the actual engines that drive the flight as such, but, the infrastructure within the airplane needs to work. Honeywell makes that. So it's not something that, it's not something as ubiquitous as an iPhone or Nike taggies. But Honeywell touches every single bit of your life every single day. They manufacture, for example, very clever AI robotics that manage warehouses. So, Takealot's warehouse has got some very clever tech in it that decide where the boxes go and the picking that happens. Honeywell does the back-end logistics of that in the warehouse. So that's the kind of business that we like to buy, where it's got a moat, it's got tech, and it's got size. And that's the kind of thing we put in clients' portfolios.
Well, what I like about how you just explained how you guys pick it is, on the one hand, you are looking at things absolutely from a very deep investigative point of view, where you've got the analysis, you've got the people that investigate, make sure that the value is right. And on the other hand, it's very practical. Buying into Vodacom or buying into your bank, that's where you build your share portfolio, because if you're banking with them or if you have your cell phone contract with them, surely you must believe that that company is good. Otherwise, you would not be doing business with them. So I like the way that the two almost marries each other in order to make a decision in terms of going forward in your share portfolio.
Yes.
It makes 100% sense. And I think this is the thing. It is very complicated, but it is also very simple.
Yes. That's well put.
Okay, so let's see. One of the biggest concerns for clients is the possibility of loss or market downturns. So what is your opinion on this, and how would you explain such scenarios to help clients understand and cope with potential losses or periods of negative growth? What would you say to somebody that is really always concerned about the downturn? I mean, after we've now spoken about this, we have to accept that if you want to be invested in a growth portfolio, you have to accept that there's most probably going to be volatility, because you have to buy into businesses, you have to buy into shares in businesses. So the most common concern that people have is, but I don't want to see my money fall. But that's what happens with companies and with shares. It goes up and down, up and down. So this is basically where this long thing comes from. People's biggest concern is the possibility of loss and market downturns. What would you say to people? How should they think about it or approach it when it comes to their investments? Especially if they want to be successful investors and really build wealth into the future.
Yeah, Corné, that's a very tough question. And it basically comes back to some of our earlier points, asset allocation. Okay, so if you cannot afford volatility in your portfolio, you need to revisit your asset allocation. That's my first response. The more direct response to your question comes to markets are driven by human beings. Humans are by their very nature emotional, and markets are driven by fear and greed.
Absolutely.
Okay. Now, we've done some extensive research into this. And on pretty much every single metric, we've looked at, for example, how have markets performed based on the president in office? And guys will say, oh, no, such and such president, or the Democrats, or Obama was great and Bush was bad. We actually looked at the numbers, the hard, cold facts. There is no correlation. That's reality. There is no correlation. Okay? We've looked at global events over literally a 100-year period.
Okay.
up to and including, the Great Depression, World War II, the Korean War, the Iran-Contra crisis, 9/11, and through all those events, there is short-term volatility. And that is what ultimately drives fear into people's minds that this volatility is bad. However, if you take a longer look and you stand back, at the end of the day, you are still growing your money in excess of inflation. Okay? And that is the key. The minute as long as you're constantly outperforming inflation, your capital base is growing and not going backwards. There's a very interesting metric that we picked up on that said that literally in the past 20 years, if you missed out, and people say, yeah, but why don't you sell my portfolio before the crash, and then when it dips, you buy it back in? I promise you, if I knew that, I wouldn't be sitting here.
No, we would be in our own private.
There's literally sort of 100% of fund managers would give you that response. But the statistics that's really scary is in the past 20 years, if I said to you, if you missed the top 25% best trading days, in other words, you were not invested in the market.
You withdrew specifically because
you were worried and you were sitting in cash.
Yeah.
Your performance would have been 1/10. So just by a metric of, you would have had a 50% return over 20 years versus a 500% return. So the number is actually 488%. But the point is,
by not being invested.
by 25 trading days.
Yeah.
So it's literally one day a year. And the metric, if you distill it down even more, it comes down to roughly 20 trading days a year that make up 80% of the return in any given year. What does that mean in layman's terms? Basically, it doesn't pay you to time the market. Mm-hmm. It is time in the market.
We say that so often.
That pays you the best. So it's patience. And that's why, as a philosophy, we do not overpay for businesses. We buy companies as business owners. So the question is, if stock market systems, the tech that drives the prices, break down and crash, and you cannot trade that market for 5 years, would you still be holding that share today? So you can only sell it in 5 years.
Yeah.
Would you still buy that share? If the answer is no, then why do you have it?
Yeah.
If the answer is yes, well, then we're happy. And we're holding on to it, and we're in it for the long term.
Okay.
So the answer to your question is, you need to have time in the market and you need to have patience. And that is why asset allocation and talking to your advisors are so important.
I think the one thing that I really liked about what you just told us is about all these events in the years going back, all the downturns, 2008 Lehman Brothers, sorry,
Yes.
World Wars, etc., etc. As you go back, and I think this is what people never seem to get, is that there's been a lot of market downturns but the market has always recovered. And you can go back in stock markets to the day that they started. And from there until today, it's always an upward curve. Yes, you've got the dips in between. And I think this is what, if people once again can understand that is what volatility is. It is the occasional dip in between, but you don't want to not be there. You want to be there because if you just stick it out for the next 6 months, 12 months, year, 2 years, you're going to go through it, you're going to come back, you're going to come out better on the other side.
Yes.
And the reason you're going to come out is we just have to go and look at that graph. It starts here and it ends here. It's as easy as that.
Literally.
There we go. Fantastic. I see we are starting to run out of time, so I'm going to have to rush through a couple of questions here. How important are tax implications in various investments, in your opinion? Is it important? Is it not important? Big, small?
As a philosophy, I've learned to not make business decisions based on tax, but ultimately, you need to structure your affairs in a tax-efficient manner. So what does that mean? You can, for example, have tax-free savings accounts, which is a great way to put money into cash and earn interest. And that is a very efficient way to not pay tax and do so legally. So, have a share portfolio that pays you dividends rather than putting all your money and earning interest and then paying tax on that. So there is a consideration, but it shouldn't be the only one.
Should not be the be all and all,
No.
end all.
No.
I think that people do tend to think, once again, that we are overburdened with tax. And I think in certain instances, certain aspects, yes, maybe so. But when it comes to investments, you can benefit by having a tax-free investment or retirement annuity versus, say, a unit trust based on your personal tax bracket.
Yes.
But at the end of the day, the bottom line is if you are invested, irrespective of the tax bracket, you're better off than the person that's not invested.
100%.
Okay. How often do you believe the client should review their investment portfolios?
Courtney, that's important. I'm coming back to the whole, the discussion with the advisor, the asset allocation thing. And this is a key question. So I believe it should be once a year. Some people say more often. Ideally, not less than a year. And the reason for that is life changes, life happens. If you look back at your life 5 years ago, 10 years ago, your mindset's changed, your needs have changed, your income's changed, your portfolio, your whole balance sheet's changed. And in that context, you need to be agile. You need to adjust on a regular basis. And if we say after 12 months, we're still fine with our previous asset allocation, that's fine. We've done the work, we've looked at it, and cognitively decided that we're going to stay in the current portfolio, then so be it. And it becomes like a 15-minute exercise.
Okay.
To the extent that change is needed, you adjust and you're always on the front foot.
I hear you. So, sir, before I let you go, there's one question that I do have to ask, because I do believe that this is, if I don't ask it, people are going to say, why did you not talk about that? Because this is the big buzz at the moment. So the big buzz is all about the USA. And our friend, Mr. Donald Trump. Many people are concerned about the USA and its aggressive stance on markets and trading fees. What is your view on the topic? What is your view with regards to, especially Trump coming out and talking about these trading fees that he's going to cut and increase and everything, and how it's going to affect all the countries that they are doing business with? What's your opinion on, what's your opinion about it, and what do you see going forward in terms of, call it world economies, based on the new attitude and approach that Mr. Trump has?
Yes, that is the $1 million question, Courtney. So
It is.
I
know.
I think it's really important, and we get asked this question a lot. So as a portfolio manager, at private clients, we really need to be unemotional about this.
Yes.
Whether you like Donald Trump or not, he is the duly elected president in the United States. Okay? The citizens voted for him in a democratic process. Okay? So it is what it is. I mean, and a lot of people get really emotional about this, and you can't.
Yeah, exactly.
He's president for the next 4 years. Okay?
Whether it was by 1% or 500%.
It's irrelevant. The other thing that you need to understand, well, there are two things. Firstly, Donald Trump made certain promises during his election campaign. Okay? And to a lot of people's shock and horror, he's actually delivering on them, which is rare for politicians these days.
Yes.
Right?
Very rare.
And when we had Liberation Day, as everybody called it, there was mass panic. But the reality is, if you think about it at its core, what the previous American regimes did is America has very little tariffs in terms of importing products. Okay? What does that mean? It means their industries are exposed to other manufacturers globally that are able to do things cheaper. I'm not going to get stuck into the metrics and the fine economics of cross-border tariffs because, you can now argue, yes, but European farmers get subsidized from the government through subsidies and therefore they're able to produce agricultural goods cheaper than American farmers. It gets a very convoluted conversation. The basic principle is that American industry have effectively outsourced and lost a lot of production capacity to emerging markets, principally China. To give you context, China, I think, has got a 34% import tariff on American goods, while Americans have a 0% tariff on Chinese goods. Is that fair? To my mind, no.
Very off balance.
It is off balance. Also, Europe, same story. 20, 30% tariffs depending on the product. Certain products on, for example, into Canada, which is their neighbor, 200-300% tariffs on certain agricultural products coming from America into Canada. So Trump is right in saying it is not fair. Everybody is getting really emotional about it, but ultimately America is the biggest economy in the world. It's 25% of world GDP, and you need to basically deal with it. It's the 800-pound gorilla. They get to sit wherever they want to. Yeah. Why? Because it can.
Because they can.
Because exactly. They can. Trump understands this. If you've read his book, Art of the Deal, what he's done really well is negotiate. He's in the negotiation here. So he puts the bar really high where he says to China, your tariffs are now 200%. Everybody loses their mind, and then he goes, okay, now I'll settle at 50. It's a very crude example, but it gets the message across. That's effectively where this man's going. What is the impact on the global economy? Not quite clear. What I can say unequivocally is it is a fundamental reset of the world economy and the way we've done business for the past 50 years. Why do I say 50 years? Is because in 71, Richard Nixon moved off the gold standard, which fundamentally changed the world economy and how we measure value of money. Because right now we've got fiat. There is no gold that backs any currency in the world right now. So in that context, this is a watershed year from a global economy point of view. We're going to have to wait and see what it looks like coming in July when the 90 days expire. He's already extended some of the Chinese tariffs and some of the window periods for certain products because everybody realizes the change is coming, so we need to do something. Yes. And in that context, there is change. So in financial markets, change is the only constant. And that is my job to figure out and navigate that on behalf of clients.
Now, and I think we're going to close off on this. Based on what you just said, this year, we don't know what's going to happen because, like you say, it's the big reset. But the one fundamental that we will come back to when we do an investment portfolio for a client is whatever happens in this year that everything is being financially reset, the one constant that that you can bargain on still is the quality of the company.
Yes.
So irrespective of what happens politically, if the company that you buy into, if the value on that company is still right, if the price is still right, it's still a good company to go, irrespective of what's going to happen geopolitically.
Yes.
And I think that is something that people must start understanding, is that one person, Mr. Trump, one political party, does not change the world. Does not change the world. It has an impact, and it might be changes, but it definitely is not going to cause us all to go into...
So it's not going to upset the whole apple cart.
Yeah, no. It's not going to throw everything out. Etienne, thank you very much, sir. I really appreciate it. I really enjoyed the chat that we have.
Thank you.
And I must be honest with you, considering the questions that I've been getting on social media from people, I think this little conversation with you is most probably gonna lead to a second and a third one. So get yourself ready. Hopefully next time you come here, you won't be so rattled and stressed. And we will have a little tot of whiskey to calm the nerves. But thank you very much. I appreciate it, and looking forward to the journey that we're taking on.
Thank you.
All the best.
Thanks.
Thanks.